Trade volumes into the US are finally set to fall off, maybe even right off a cliff, down as much as 25%, according to one closely watched industry inside source. Now, trade, that's been hugely volatile over the last couple months. The LA port, for example, it saw trade volumes soar and then crash and then soar again last month. But now that we're getting past all of the artificial distortions, the real shape of the global economy, the trade and commerce in it, is starting to show up. And this is one key reason why tariffs aren't being passed on to consumers or even other businesses. There is a glut of inventory, much of it off the books, which had previously flooded into the country to beat trade wars. But now that it's here, first of all, there's going to have to be massive payback for all those producers who've been running hot to make and ship everything here. And contractions in trade to this extent mean contractions in manufacturing, in shipping, management, and yes, some services. Just how much this payback will be it's hard to guess, though this one estimate we're talking about here provides a sobering potential downside range. Worse than that, though, everybody who's been distorting in trade has been betting on Jay Powell. The mainstream view of the economy, the one that's echoed in soaring stocks, is that it remains solid. A little hiccup and rough patch more recently, but that will change in the second half as the steady labor market will have Americans back to spending in no time. Therefore, allowing all these companies to go through all this excess inventory in a reasonable time frame. But now that even members of the FOMC aren't willing to take that bet any longer, consumer spending has been unusually weak so far this year, and it's not actually looking any better. In fact, a survey from Alex Partners that just came out showed a big-time drop in online sales, while the Conference Board's leading indicators, which just came out today, flashed another recession warning. And the only reason that wasn't worse was because stocks have been rising. So not only does the goods economy risk being wrong on consumers, everyone in it has leveraged all this excess inventory in order to keep it off the books and free up working capital. This is called vendor-managed inventory, and it's great when everything is fine, but risks turning a slowdown into a deflationary downturn if banks do get cold feet with inventory that's not moving and everyone in the same boat with their own inventory gluts. Everything up until now has been the volatile prelude to what is the main event. For all the hype over stocks and Jay Powell's interpretation of the labor market, these are the real economic reasons why we're seeing all of these contradictions in far more crucial places, like the Treasury market, where yields refuse to rise despite all the hype over not just stocks, but inflation risk from tariffs to the debt supply and a whole bunch more. Yields on the 2-year continue to go down. Why are swap spreads close to negative lows, setting new negative lows? Why are they the same vicinity that they've been in since April? These real economy reasons that we keep coming back to, which are the second half of the year, as difficult as the first half was, it is poised to be the main event. And to that point, Bloomberg earlier today reported the number of shipping containers carrying U.S. imports fell for a second straight month, a private gauge showed, putting the economic indicator on course for one of the sharpest year-over-year reversals on record. Inbound container volume fell 7.9% in June from a year before, after a 6.6% drop in May, veteran industry analyst John McCown wrote in a monthly report Sunday based on the 10 largest U.S. ports. After a 15% gain last year, quote, "It is now most likely that there will be a decline in overall inbound volume in 2025, said McCown, whose mentor was Malcolm McLean, the North Carolina trucking executive who pioneered containerization in the 1950s. McCown said he was only aware of 2 periods of annual volume declines during the global financial crisis, which was not financial, and of course the pandemic. And both were short-term slumps, at least relatively speaking, where it came to global trade. As far as the real economy was concerned, not so much. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. But you rarely ever see a fall off in trade like the prospects that we have looking forward from here. In fact, McCown said that he estimated a 25% reduction in U.S. container volumes is, quote, readily possible and would translate, quote, directly into a $510 billion reduction in annual commerce for the U.S. $500 billion reduction in annual commerce, which is not just less goods being sold in the United States. That means less manufacturing, less production, less assembly, less shipping, less management. A lot of services that go into all of that as well. That would be a huge hit to the U.S. economy. And of course, the rest of the world would feel it just as much, if not more. But it's been difficult to get to this point since up until now, there have been massive distortions all across supply chains due to front loading of tariffs. Then tariffs are implemented and fears and everything falls off. And then the more tariff delays, which means even more front loading activity. Perfect example, as I mentioned in the introduction, the port in LA. According to CNBC, it was the busiest June in the 117-year history of the port, but port officials have stressed in recent commentary that the increase in freight should not be referred to as a surge, and that tone was reiterated with the June numbers now official and an 8% improvement over last year. Port of LA Executive Director Gene Soroka said that more than anything else, the monthly data highlights the tariff whipsaw effect. Imports had slowed significantly in May and continued to drop through the first half of June and then turned around with geopolitical reasons, not necessarily economic. But as LA is seeing back and forth, overall what we're seeing is downward trend in global trade. Into the US, outside of the US, basically everywhere. There was so much artificial distortions in the first half of the year, it was inevitable that there would be a payback period at some point. And all the data continues to point to that point being right around here. Now, what we don't know yet is how big the payback will be, but we're starting to get a sense of that as well. As Mr. McCown was writing, he can foresee a reasonable estimate and range of around a 25% drop. Now, that may be more extreme, but it needn't be a 25% drop in order to create substantial economic disruption in the second half of the year, especially given where consumers in the U.S. are already, and it's not in a good, solid place. And of course, all of this is stuff that we've been going over at Eurodollar University in our memberships as well as our subscriptions. We've got an anniversary sale that's still ongoing. Check out our website, eurodollar.university, for all the details, especially the deal we've got on Eurodollar University memberships. We've also got a brand new subscription service over at Substack. If you're interested in checking that out, you get one of our posts for free when you go over to Substack and subscribe to our page. All the details are available at our website, eurodollar.university. But having all of that inventory show up in the United States means that that's a consistent pressure on company operations. They prefer not to lock up all their working capital on inventory that they have no plans of nor prayer of selling anytime soon, as CNBC also reported. Among both U.S. and global firms, use of supply chain financing programs that allow importers to stretch out payment terms is up, according to Wells Fargo data, anywhere from 5 to 10%. Cash is good to have, said Jeremy Jansen, who's the managing director and head of global supply chain and trade sales at Wells Fargo. There's a lot of uncertainty. If you're a distributor or manufacturer, there's a ton of pressure to push out payment terms. From large retailers to auto parts stores and manufacturers, buyers of both finished goods and raw materials, tariff pauses allowed importers to bring in more inventory. That's the artificial front loading. But once the inventory arrives, it may be bound for financing rather than straight to market. And if it is bound to financing, that means it bounces right off the books of the importer and onto the hands of a third party. Using what's called here vendor-managed inventory, rather than have to finance the goods while waiting longer to sell them, They finance the stock while freeing up cash for other working capital purposes. So whenever something gets shipped and the invoice gets sent to the bank, where the bank pays the vendor on the other side, and the importer repays the bank at some time down the road when it actually takes possession of the goods back to the firm. So paying a little bit more in interest and fees for vendor-managed inventory is the far better option than waiting until tariffs hit, bringing in the goods when it's actually going to be sold to end consumers, and paying the full price to do so. But all of this is betting on the economy to turn around in the second half of this year, and that the first half weakness that we've already seen was only tariff-induced uncertainty and an overreaction among consumers to the overreaction in the stock market. That's the stock market view. That's Jay Powell's view. But what if they weren't actually overreactions? Then we've got tons of overstocking on all of these imported goods and other goods beside, all on borrowed money. And if demand doesn't turn around, the inventory as the collateral for all that financing risks being marked down, adding to the deflationary potential that's already high to begin with such hugely distorted balance on goods before we even get to all this financing. We got a ton of goods, a ton of leverage on those goods, tons of distortions all over the supply chain. No wonder they do say uncertainty. Now, the term uncertainty is way overused, but in this sense of the word, it does apply. There's a ton of uncertainty. Nobody really knows for sure, and all of it is really betting on, oh boy, Jay Powell finally getting it right on the real economy. Forgot how to grow doesn't become remember how to do worse. But that's where we get all of these leading indicators, including from the conference board and some other surveys beside, that suggest it wasn't just an overreaction in terms of sentiment in the first half of this year, and that the second half of the year, as far as consumer spending goes, and a whole lot more, everything's pointing even further downward. The conference board earlier today reported that its leading economic indicators were down 0.3% month over month for the month of June 2025. That was after a zero reading in May. And the zero reading in May was largely influenced by the upside to the tariff distortions. But far more importantly, the 6-month change in the leading economic indicators, the LEI, accelerated to minus 2.8%. That indicates a big loss of economic momentum, which we've been talking about since April, that has carried through here into June. Now, the 6-month change got as high as plus 1% back in February with all the artificiality, but it's been falling steadily ever since then rather than stabilize or turn around as the stock market would have you believe. In fact, the stock market itself is the only real positive factor in the LEI in June and over the last couple of months too, which means the LEI, apart from stocks, is significantly worse. Even the press release from the conference board said the same exact thing. Quote, the U.S. LEI fell further in June, according to Justina Zabinska-Lamonica, who's a senior manager in business cycle indicators at the conference board. For a second month in a row, the stock price rally was the main support of the LEI. But this was not enough to offset still very low consumer expectations, weak new orders in manufacturing, there's the payback, and a third consecutive month of rising initial claims for unemployment insurance. In addition, the LEI's 6-month growth rate weakened, while the diffusion index over the past 6 months remained below 50, triggering the recession signal for a third consecutive month. Now, the conference board doesn't want to call it a recession because they're gun-shy about calling anything a recession. But what we're really talking about here is the LEI says we had the forgot how to grow economy that encountered an artificial high that I've been telling you about all year, got the artificial high last year, and now it's rolling back over into the uncertain payback period. So either way, it's just a forgot how to grow recession, forgetting even more growth to the point it might be remembering a whole bunch of very important and highly unusual weakening. This is contrary to most people's perceptions of the consumer economy to begin with. They take their, the short-run news, short-term focus on things like retail sales for the month of June. Retail sales did rebound in June, but it didn't even make up for the decline in May, let alone the decline in May plus April, let alone the weakness overall for the first half of this year. So retail sales increased by 0.64% month over month in June, but fell by an even sharper 0.87% in May, and had been down by 0.1% back in April. So you put the back and forth together, all of this distortion in activity, for the first half of this year, retail sales in nominal terms are up just 0.68%, and that's at an annual rate. An annual rate of 0.68% is terrible. That is well within recession territory. And in real terms, it's even worse. In real spending, adjusting for the CPI, retail sales were up just 0.35% in June. We're down almost a full percent in May, having been down 1/3% in April. So for the second quarter overall, real retail sales were deeply negative. In fact, the annual rate for the first half of the year, minus 1.75%. That is entirely consistent with an economy that's struggling along in a traditional outright recession. The Conference Board may not want to use the R word, but U.S. consumers already are in how they're behaving. Now, I've already mentioned real personal consumption expenditures, which includes services, whereas retail sales focus mainly on goods. Real PCE, we've only got 5 months of data from the Bureau of Economic Analysis up through May. We'll get an update in about a week or so. But for the first 5 months of this year, real PCE is negative. And it's only one of a handful of times that we've seen something like that happen. And while consumption expenditures were likely to rebound in June, and that will allow spending to end the first half on a positive, it'll be a very small positive for a 6-month period, the first half of this year, which will be the worst first half of the year, any year outside of 2020 and 2009. And where have we heard that before? In fact, we keep running across all of these comparisons. This is as bad as we've seen since 2020 or 2009. This is the worst that we've seen in the marketplace since 2020 or 2009. This is the worst for average weekly earnings among non-supervisory and production employees, regular workers, their paychecks negative for the first time since 2020 and 2009. We also got word earlier this month from a firm called AlixPartner, which is a closely watched company that keeps track of these types of things. And as CNBC reported, the e-commerce sector is experiencing its most disruptive period in more than a decade as a result of President Trump's trade war and tariff policies, according to a new survey. It's not really trade wars. It's really the weak economy that got hit with a shock that it just couldn't absorb. It finds steep declines in online shopping activity and shipping and return policies being adjusted to cut costs for companies. Online purchases for home delivery experienced double-digit percentage year-over-year declines across major categories, including office supplies, no surprise there, down by 13 percentage points, sporting goods down 12 percentage points, and cosmetics, furniture, home furnishing, and large electronics each falling by 10 percentage points. This marks the first widespread pullback in online category growth in over a decade, said Chris Considine, who's a partner with the consulting firm's retail practice. And it's consistent with all the other data we've been talking about showing discretionary spending among consumers is falling off. So you've got real weakness in the labor market. That's where all of this comes from. Forgot how to grow economy, had sapped the labor market strength long before we even got here. So real substantial weakness in jobs and incomes that leads to a pullback in discretionary spending, which leads to, at the worst possible time, this inventory piling up for non-economic reasons that's even further imbalance between demand and supply. And it leads to this payback period. We've got consumer spending falling off, way too much inventory. It's a real bad mix of all these real key fundamental prospects and factors. So given all this and the prospects for payback, real prospects for payback, and all of these bad bets across the economy, betting on Jay Powell, according to the marketplace, no wonder the market is behaving the way it is. And of course, I'm not talking about stocks either. I went over the difference between the stock market and fundamental markets like swap spreads in a video a couple days ago. The stock market's soaring ahead on the idea that any weakness earlier this year in share prices or even the economy was just an overreaction to tariffs. That's what Jay Powell's been saying. It's just too much negative sentiment and nothing beside. But all the evidence continues to show something completely different. What is priced into the swap market? What is the swap market pricing? That interest rates overall are going to go down by a lot and then stay there for a very long period of time. And a large payback period in the global economy, including the U.S., would certainly be consistent with what the swap market has been pricing more and more confidently since the outbreak of deflation in April. And as of today, we've got nominal treasury yields that are falling. Again, the 10 years back down to 4.35%. It's basically been a pretty narrow range all year. The 2 years down to 3.84. 3.84 being consistent with an economy that's going to be experiencing the Federal Reserve rolling over and cutting rates all over again. Even Treasury Secretary Bissett said earlier this month, the committee seems to be a little off in their judgment, referring to the FOMC. This was in an interview with Fox Business. The Treasury chief has repeatedly said he would only comment on past Fed policy, not prospective decisions. Even so, he repeated his argument that, quote, 2-year rates are telling us that the overnight rate is too high. Okay, but why is it too high? He says it's because consumer price rates, or what they call inflation, has come down. Therefore, interest rates can come down, but that's not how the market actually works. The 2-year is low. It's sub 4% and continues to be sub 4% because growth potential that isn't potential any longer. What I mean is these are not economic risks anymore. The risks are becoming reality right before our very eyes. So we've been warning about Payback since last fall when the artificial high first started making its noises. The trade numbers and distortions were just simply huge, which that was not economic growth picking up. That wasn't a brighter future. That was, as I said, just a distortion. The more that came into the country to beat tariffs, the worse the payback would have to be, risking potentially an air pocket in demand around the world. And this latest data that we're getting is not encouraging, at least for that part of it. A huge decline in trade and container traffic, for example, maybe even the worst since outside of 2020 and in 2009. You put that together with a shaky consumer environment, to put it charitably, the off-the-books inventory that's all there is more than just the usual overhang. And it is a leveraged overhang this time, which depends upon the FOMC getting everything right about the economy this year, when this year everything up to including FOMC dissent has been going increasingly wrong. And of course, that wrong is priced into swap spreads, which are barely moved from where they had been at their lows in April. In fact, some of them are challenging new lows and are likely to set them in the near-term future. Went over all that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.